essentially bonds are debt. Okay, they are debt. So when you buy a bond, you are essentially becoming the lender. All right. Okay. So let's say, so one of the most common types of bonds that we've seen are Series EE bonds. So these are usually physical certificates, right? That you may have gotten from your grandma, your aunt, or somebody in your family that's financially conscious probably went out and bought you at least one bond in your life, right? So they're a certificate that essentially doubles in, it reaches the face value after 20 years. So let's say if you buy a bond that has a $500 face value, you would pay $250 for that bond right now, and then in 20 years it would double. Okay. Right? That is too long. Right. Too long. So I always tell, like, my grandfather, he saved up tons of bonds for me, but if he had actually put that money in the stock market, I don't know, I probably wouldn't even be here right now, to be honest. Right? Yeah. So, just you can get more returns there. But essentially what another example of a bond you may hear about, corporate bonds or government bonds. So an example of that, like, I'm from DC, right? But I live in Miami. So let's say if Miami was like, we want the politicians in DC to be able to get to Miami super fast, or a super fast train. I don't know, right? So we don't have the money, so we're going to raise the money, right? Okay. We're going to raise the money to build this train. So essentially we could put out maybe a municipal or a government bond, and people throughout the country can buy this bond, essentially lending money to Miami. And then Miami will pay you back. Let's say you bought a bond, Marsha would pay you back principal plus interest every single month or quarter or whatever they specify, just like how we pay our rent, how we pay our mortgage, how we pay our student loans, et cetera. So that is another way where people can essentially kind of like lend money out and get back principal interest, more consistent payments over time. So that's another reason people like bonds, especially if they're getting closer to like retirement, because it creates more consistent income. And bonds are traditionally a lot more safer. Right. They can preserve that capital. Preserving the capital meaning the money that you're actually investing. Right. Got it. So we're becoming the lender. Yeah. Right. You're becoming the lender. We're becoming the lender. And you don't have to worry about like the market ups and downs when you're buying bonds, because typically whatever you're lending out or buying, that principal amount that you're putting in doesn't fluctuate.